$46 per ounce. Gone. Not over a week. Not over a month. In 6 hours. Silver opened Friday morning at $121. By the time New York closed, it was sitting at $75. That is a 37% collapse in a single trading session. Let me put that in perspective for you. If you had $100,000 in silver Friday morning, you had $63,000 by dinner. $37,000 evaporated while you were at work, while you were stuck in traffic, while you were making coffee and checking your phone. Gold did not escape either. $5,600 became $4,700. Nearly $1,000 an ounce erased like it never existed. Now, here is what should bother you. I checked every news feed. I scanned every financial outlet. I searched for any breaking headline that could explain this. Nothing. No war declaration, no pandemic announcement, no major bank failure, no emergency Fed meeting, no presidential executive order. The wires were silent. The newsrooms had nothing. Complete radio silence from every financial institution on the planet. A 37% crash in precious metals, the biggest single-day destruction in decades. And nobody had a reason. They want you to believe this was random. They want you to shrug and call it volatility. They want you to accept that sometimes markets just do this. I am going to show you exactly why that is a lie. And when you see what I found, you will never look at precious metals the same way again. What happened on Friday was not an accident. It was not a correction. It was not profit-taking or healthy market behavior. It was a controlled demolition. And the blueprint they used? It is the same one they have used before. Twice. In the last 50 years. Same setup, same weapon, same outcome. 3 times in half a century, silver threatened to break free. 3 times, the same mechanism activated. 3 times, regular people watched their gains disappear overnight. This is not speculation. I am not connecting dots that do not exist. Every piece of data I'm about to show you is publicly available. The dates are documented. The margin requirements are on record. The price charts tell the story. Anyone can verify what I am about to reveal. Most people just do not know where to look, or they do not want to believe what they find. By the end of this video, you will understand exactly how silver gets crushed every time it runs too high. You will see the pattern with your own eyes, and you will know why they keep doing it. Welcome back to Channel Name. This is where we decode what is really happening in financial markets while mainstream media feeds you distractions. If you are new here, subscribe right now. Hit that notification bell. Because this is the kind of analysis that disappears from recommended feeds. The algorithm does not like this content. You need to be subscribed to make sure you see it, and if this video opens your eyes, smash that like button. Not for me, for the next person who needs to understand what just happened to their portfolio. Let us break this down. Friday, January 30th, last trading day of January, last trading day of the week. Silver is at $121 an ounce. It has been the best month for silver in living memory, up 65% in just 30 days. Analysts who normally hate precious metals were calling for $200. The bold ones were saying $300. Social media was euphoric. Reddit was celebrating. Twitter was flooded with screenshots of portfolio gains. Everyone thought they had finally cracked the code. Buy silver, get rich, beat the system. Retail traders were all in. Mom-and-pop investors who had been stacking for years finally felt vindicated. The metal they believed in was proving them right. Gold was at $5,600, also at all-time highs, also breaking records every week. The narrative was clear. The dollar was dying. Inflation was permanent. Precious metals were the only safe haven. Buy now before it doubles again. That was Friday morning. Then 9:30 a.m. hit. The New York market opened. Within the first 60 seconds, something was wrong. Sell orders started flooding in, not retail orders, not small traders taking profits, massive institutional blocks. Millions of ounces being dumped simultaneously across multiple exchanges. Silver dropped from $120 to $118 in minutes, then $115, then $112. Then it broke below $110 and the real panic started. $105, $100. That psychological level everyone said would hold forever, the support that was supposed to be unbreakable, gone in less than an hour, but it kept falling. $95, $90, $85s. Stop-loss orders were triggering across the entire market. Every protective sell order that traders had set up was executing automatically. which created more selling, which triggered more stop losses. A cascade of forced liquidation that fed on itself. $80, $78, $76. Margin calls were going out to trading accounts across the country. Deposit more cash immediately or your position gets liquidated. Most people could not respond fast enough. The system sold them out automatically. By 4 p.m., silver was at $75, $121 to $75. 6 hours, 37%. I watched the trading screens in real time. I watched the numbers fall. I watched the comments flood in from people who had just lost everything. Years of savings, retirement funds, money they could not afford to lose. And the question everyone was asking was the same. What the hell just happened? Within hours, the financial media had their explanation ready. Markets got ahead of themselves. Silver was overbought. Healthy correction after an unsustainable rally. Profit-taking was inevitable. That is what they told you. That is the story they want you to believe. Markets go up, markets go down, nothing to see here. But they left something out, something critical, something that explains not just what happened, but exactly how it was engineered. Let me show you what actually happened in the 60 days before Friday. Pay attention to the dates. December 12th, silver is surging, headlines everywhere, retail investors piling in. The rally is accelerating. That day, the CME Group, the exchange that controls silver futures trading, announces a margin requirement increase. 10%. This barely makes the news. Most traders do not even notice. December 29th. Silver keeps climbing. The rally has not slowed down at all. Analysts are raising price targets. CME raises margins again. This time it is 25%. Overnight. No warning. No gradual phase-in. December 30th. Less than 24 hours later, they raise margins again. 2 hikes in 2 days. That almost never happens. January 28th, 3 days before the crash, CME changes the entire margin structure. They move from fixed dollar amounts to percentage-based requirements. 9% becomes 11%. For accounts they deem higher risk, it goes to 12.1%. 4 margin hikes in 6 weeks. An 80% total increase in the cash required to hold a silver futures position. Now let me explain what that actually means. When you buy silver futures, you do not pay the full price up front. You put up a fraction of the total value as collateral. That is called margin. It is how leverage works. If silver is trading at $100 and the margin requirement is 10%, you only need $10,000 to control $100,000 worth of silver. The exchange holds that cash as your guarantee that you can cover losses. But when the exchange raises margin requirements, every single trader holding a position suddenly needs more cash. Not next week, not when it is convenient, right now, today, within hours. Here is an analogy. Imagine you are renting an apartment. You have been paying $2,000 a month for years, never missed a payment. Then one morning, your landlord calls and says your rent is now $3,600, an 80% increase, and you have until 5 p.m. today to pay the difference or you are evicted. No negotiation, no appeal, no payment plan. That is essentially the phone call that went out to every leveraged silver trader in America at the same time. Your account needs 80% more cash. Deposit it in the next few hours, or we are liquidating your position. Most people do not have that kind of money sitting in their bank account waiting to be transferred. They cannot meet the call, so their positions get sold automatically. And when thousands of leveraged traders are forced to sell at the exact same time, what happens to the price? It does not decline, it collapses, 37% in 6 hours. This is not the first time this has happened. Let me show you the pattern. 1980. Silver runs from $6 to $50 an ounce, an 800% gain in just a few months. The Hunt brothers are trying to corner the market. Regular people are making fortunes. The system is under pressure. What happened? The CME creates something called Silver Rule 7. Effectively bans leverage buying overnight. If you want to buy silver futures, you have to pay 100% cash, no margin allowed. At the same time, Federal Reserve Chairman Paul Volcker raises interest rates from 11% to 20% in a single move. The result? Silver crashes from $50 to $10, an 80% wipeout. The Hunt brothers go bankrupt. The rally is over. 2011, silver runs from $8 to $50 an ounce, a 600% gain. Retail investors are flooding in. Banks holding massive short positions are getting destroyed. What happened? The CME raises margin requirements 5 times in 9 days, 5 separate increases in less than 2 weeks, an 84% total increase. The result? Silver crashes from $50 to $26, a 50% collapse. It took 13 years for silver to recover from that crash. 13 years, 2026, silver runs from $26 to $121, a 450% gain, the biggest rally in modern history. What happened? CME raises margins 4 times in 6 weeks, 80% total increase. The result? Silver crashes 37% in a single day. The fastest destruction of the 3 events. Same setup, same weapon, same destruction. 3 times in 50 years, silver threatened to break free from the paper system. 3 times, the same mechanism activated. 3 times, regular people holding leveraged positions got wiped out. Once is an accident, twice is a coincidence, 3 times is a pattern. The question you should be asking is not just how this happened, it is why. Why does anyone care enough about silver to run this playbook 3 times in half a century? The answer has nothing to do with silver itself. It has everything to do with what silver represents. The United States has one superpower that no other nation possesses. The dollar is the world reserve currency. Every country on Earth needs dollars to trade oil, to conduct international commerce, to hold reserves in their central banks. This is why America can print trillions and not immediately collapse. This is why they can run $34 trillion in national debt and keep spending, because the entire world is forced to use their currency. But that privilege is slipping. Last year, central banks around the world bought 800 tons of gold. Not dollars, not treasury bonds. Physical gold. In January alone, foreign central banks sold $48 billion worth of U.S. treasuries. $48 billion in 1 month. The dollar's share of global reserves just dropped to 58%, the lowest since 1995, a 30-year decline that is now accelerating. And here is the statistic that should terrify Washington. For the first time in modern history, gold now represents a larger share of central bank reserves than U.S. Treasury bonds. Central banks around the world now trust metal more than they trust America's promise to pay. That is not a small shift. That is the foundation cracking. Now look at who is positioned on the other side of this trade. China controls 60 to 70% of global silver refining. Not mining. Refining. They are the gatekeeper. Silver gets mined in Peru, Mexico, and Australia. But it all gets processed in China. China controls 90% of rare earth processing. The materials in your phone, your electric car, your military weapons. They control 98% of gallium refining, essential for semiconductors. They control 80% of cobalt processing. That is, in every lithium battery. They control 60% of lithium refining. The green energy revolution runs through Chinese facilities. And on January 1st of this year, China classified silver as a strategic national security resource. They put export controls on it. Same category as military materials. 2 superpowers. 2 completely different visions for the future. China wants a world where physical resources matter, where nations controlling supply chains hold power. They have spent 30 years building exactly that position. America wants the opposite. America needs metals to stay cheap. They need gold to stay quiet. They need wealth parked in dollars and assets they can monitor and control. Because if silver goes to $500, what does that say about the dollar? If gold hits $10,000, what message does that send to the world? It says the paper has failed. It says 50 years of money printing has caught up. It says the game is over. That message cannot be allowed to spread. So they crush silver. Same way they did in 1980. Same way they did in 2011. Margin hikes. Forced liquidation. Price destruction. Meanwhile, China buys the physical metal. They drain the vaults. They accumulate while the West panic sells. This is not market management. This is financial warfare. East versus West. Paper versus metal. Dollar versus commodities. Friday was a battle in that war. You watched it happen in real time. Here is what should disturb you most. Before Friday, when silver was still at $121, mints were already struggling to meet demand. Perth Mint had suspended wholesale orders. The U.S. Mint halted Silver Eagle production. Dealers were defaulting on deliveries. The price was $121, and you still could not buy physical silver easily. Now the price is $75. Try buying an ounce today. Call your local dealer. Check the online retailers. See what premiums they charge over spot price. See if they have any inventory at all. Paper silver and physical silver are not the same thing. Paper can be created with a keystroke. Paper can be crushed with margin hikes. Paper can be manipulated whenever they choose. But physical silver cannot be printed. It cannot be margin called. It exists in the real world outside their control. When you hold physical metal, no one can force you to sell. No one can change the rules overnight and liquidate your position. It is yours. While American traders were getting liquidated on Friday while the paper price crashed 37%, Shanghai vaults drained 27 tons of silver in a single week. Physical delivery, actual metal leaving the vault and going to buyers who wanted it in their hands. America dumps paper contracts. China takes delivery of actual metal. America crashes the price. China says thank you for the discount. One side trades promises on screens. The other side loads trucks with actual bars of silver. Which side understands what silver is really worth? Here is what did not change on Friday. Silver has been in a supply deficit for 5 consecutive years. Every year since 2021, more silver has been consumed than mined. The cumulative deficit is over 800 million ounces. That is nearly a full year of global mine production that simply does not exist. Industrial demand is exploding. Solar panels need silver. Electric vehicles need silver. Electronics need silver. AI data centers need silver. Military systems need silver. That demand grows every single year. It is accelerating. Meanwhile, supply cannot keep up. No major new silver discoveries in years. Ore grades declining at existing mines. It takes a decade to bring a new mine online, even if you find silver today. Production costs keep rising, demand rising, supply constrained, deficit growing. None of that changed because of one crash. The deficit is still there. The demand is still growing. The supply is still falling behind. The fundamentals did not blink. What changed on Friday was a paper price, a number on a screen. A number controlled by futures contracts and margin requirements that can be adjusted whenever the exchange decides. Paper prices can be manipulated. Physical supply and demand cannot. Not forever. I need to be straight with you. I do not know if $75 is the bottom. Could silver fall to $50 from here? Yes, absolutely, if they keep raising margins. If dollar strength continues. If the forced liquidation is not finished, silver could absolutely go lower. Could it bounce back to $100 next month? Also possible. If physical demand overwhelms the paper manipulation, if the shortage becomes acute, if geopolitical tensions escalate. Nobody knows what happens next. Anyone claiming certainty right now is lying to you or selling you something. What I can show you is the pattern. What I can document is the mechanism. What I can prove is that this has happened before, and both times silver eventually recovered. After 1980, silver came back. After 2011, silver came back. Both times it made new highs eventually. They can suppress prices, they have the tools, but they cannot do it forever. Physical reality wins eventually. It always does. The question is timing. And that, nobody knows. But here is what stays with me. If silver does not matter, why do they keep doing this? Why run the exact same playbook 3 times in 50 years? Why coordinate margin hikes right before crashes? Why does the CME care so much about the price of a metal they claim is just a commodity? They say it is risk management. They say it is market stability. They say they are protecting traders. But look at what happened on Friday. Traders got destroyed, billions in losses, accounts wiped out, years of gains gone in hours. They are not protecting traders. They are protecting something else. The dollar, the system, the narrative that paper money still works. The fact that they keep doing this, the fact that 3 times in 50 years they have crushed silver whenever it started to run, the fact that they cannot let it trade freely, that tells you exactly what silver threatens. And exactly what they fear. In 1980, they told you they crushed silver to stop manipulation. In 2011, they told you they raised margins for market stability. In 2026, they are telling you this was just a healthy correction. But you can see the pattern now. They called it a crash. I call it a controlled demolition. They called it volatility. I call it the same playbook executing for the third time. They called it risk management. I call it the system revealing what it fears most. You do not fight this hard against something that does not matter. The intensity of the attack tells you the value of the target. Remember that. 37% in a single day. No news, no explanation. Complete silence from everyone who should be explaining it. Now you know why. The margin hikes, the forced liquidation, the pattern from 1980 and 2011. China accumulating while America dumps. Paper versus physical. A financial war that nobody on television will talk about. The data is public. The dates are documented. The pattern is there for anyone willing to look. What you do with this information is entirely up to you. But understand this. Friday was not a market event. It was a message, a reminder of who controls the paper price, a demonstration of power. But it was also confirmation that silver still matters, that precious metals still threaten the system, that after 50 years of unlimited money printing, they still have not figured out how to make gold and silver irrelevant. And that might be the most bullish signal of all. This is Supreme Economy. I will see you in the next one.